In Chapter 7, we learned what bonds are. We learned what yields are. And we learned that they move in opposite directions. Price up, yield down. Price down, yield up. Always. We also learned something really important. That yields attract money. When Australian yields rise, money flows toward Australia. Investors buy Australian bonds. To do that, they need Australian dollars. Demand for AUD rises. AUD USD goes up. And when US yields rise, money flows toward the United States. Investors buy US bonds. To do that, they need US dollars. Demand for USD rises. AUD USD goes down. So we already have two useful signals. Australian yields telling us something about AUD. US yields telling us something about USD. Two separate pieces of information, both relevant to the same pair. But here is where it gets really powerful, because we can combine them into a single line, using the exact same concept we learned in Chapter 6. Remember what we did with the synthetic baskets? We took the AUD basket. We subtracted the USD basket from it. And the result was one line, the synthetic spread, capturing the net directional bias between the two. We are going to do exactly the same thing here. But instead of synthetic baskets, we are going to use bond yields. For this example, we will use the 2-year bond yield. Australian 2-year bond yield minus US 2-year bond yield. One number, one line, the yield spread. And just like the synthetic spread, this single line tells us something that neither yield can tell us alone. It tells us the net yield advantage of one country over the other, right now, in real time. When the yield spread is positive, Australian yields are higher than US yields. Australia has the yield advantage. Money is more attracted to AUD than to USD. AUD-USD has upward bias. When the yield spread is negative, US yields are higher than Australian yields. The United States has the yield advantage. Money is more attracted to USD than to AUD. AUD-USD has downward bias. And when the yield spread is flat, neither country has a meaningful yield advantage over the other. The pull of money is roughly equal in both directions. Less conviction, less directional bias. Think back to the tug of war from Chapter 6. Two teams on a rope. Now, instead of synthetic baskets, the teams are the yield environments of two countries. Australia pulling on one side, the United States pulling on the other. When Australian yields are higher, Australia is pulling harder. The rope moves toward AUD. AUD-USD goes up. When US yields are higher, the United States is pulling harder. The rope moves toward USD. AUD-USD goes down. Now let us bring everything together, because this is where the picture becomes truly complete. We now have two entirely independent tools telling us about AUD-USD. The first is the synthetic spread, built from correlated and inversely correlated instruments, giving us a read on currency strength and momentum right now. The second is the yield spread, built from the bond yields of Australia and the United States, giving us a read on where capital is being attracted right now. These two signals come from completely different places. One from price relationships between currency instruments, one from the bond market. They are measuring different things, but they are both telling us about the same underlying question. Which direction is money flowing between AUD and USD? And when both signals agree, when the synthetic spread and the yield spread are both pointing in the same direction, we have something very powerful. Two independent confirmation signals, aligned, telling the same story, from two completely different sources. That alignment is where real confidence comes from. Not from one signal, not from hope, but from multiple independent pieces of evidence, all pointing toward the same conclusion. In our next chapter, we are going to bring all of this together in a practical setting. We are going to look at how we combine the synthetic spread and the yield spread to build a clear framework for making trading decisions on shorter timeframes. And then, finally, we are going to walk through the indicator that does all of this for us, automatically, in real time, on our chart. See you in the next chapter.